Hello and welcome. Supreme Court strikes down tariffs, but trade uncertainty isn't over. Markets don't hate tariffs, they hate uncertainty. And this week, uncertainty is back in focus after the Supreme Court struck down a key set of tariff measures tied to President Trump's earlier trade authority. But here's the twist. Even after that decision, President Trump has continued signaling that broader global tariffs could still be imposed through alternative executive pathways. So now investors are asking, are tariffs off the table or are they coming back just in a different form? And that question is creating volatility across multiple sectors. Let's break it down. First, let's address what happened legally. The Supreme Court ruled against a previous tariff structure that relied on emergency executive authority to impose broad import taxes. The ruling essentially said the scope exceeded statutory authority as structured. So markets initially reacted positively because fewer tariffs generally mean lower input costs and smoother global trade. But that relief rally faded quickly. Why? Because President Trump has publicly indicated he may pursue new or revised tariff frameworks, potentially including broader import tariffs, country-specific penalties, and sector-specific trade actions, and that reintroduces policy unpredictability. So here's why the markets care so much. Tariffs directly affect corporate margins, supply chain, inflation, and global demand. When policy is clear, companies adapt. When policy is unclear, valuation models widen and stocks reprice. That's what we're seeing now. Industrials tend to be the first to react. Input costs, especially steel and components, they could rise again. We've already seen industrial stocks trade with increased headline sensitivity. Industrial and manufacturing stocks most exposed to global supply chains, import inputs, and export demand are the ones feeling the downside. Although technically a cyclical industrial, car makers like Ford Motor Company are under pressure from supply chain cost headwinds and consumer demand uncertainty. Now to technology and semiconductors and the supply chain risk. Tech is deeply global. If broader tariffs are imposed, especially on Asia-linked imports, hardware margins could tighten. Semiconductor names like Advanced Micro Devices, AMD, are exposed not just to tariffs, but to export controls and geopolitical retaliation. Even if AI demand remains strong, multiple compression can occur if investors perceive rising geopolitical risk. Tech stocks are pricing in earnings growth, but also pricing in trade stability. Next, retail and consumer pressure. Retailers like Walmart import massive volumes of consumer goods. If tariffs return in expanded form, either prices rise for consumers or retailers absorb costs and margins compress. In an environment where consumers are already navigating elevated interest rates, that risk matters. Consumer discretionary stocks are especially sensitive here. And financials are watching business confidence. Banks like JP Morgan and Bank of America aren't tariff targets, but they are economic barometers. If trade policy uncertainty reduces business investment or capital spending, loan growth could slow. But markets are watching business confidence surveys closely. So, the key market question, the market isn't asking, are tariffs legal? It's asking, are tariffs coming back? And how aggressive will they be? If the administration clarifies policy direction and creates a defined framework, markets can adjust. And until clarity returns, globally exposed sectors will continue to react to every headline. If you want sharp, stock-specific breakdowns without the noise, subscribe and click on the notifications button for daily market updates. I'll see you in the next one.